discover the behind the scenes of investment strategies shaping the global financial landscape. Today, we'll explore valuable insights inspired by Warren Buffett's unique perspective on ever-changing markets. From bold moves by renowned investors to paradigm shifts in the perception of money, this video will provide a profound and dynamic analysis. Uncover the impact of Michael Burr's billion-dollar bets, explore opportunities in regional real estate markets, and understand why cash may be your safe haven. Additionally, we'll reveal how economic downturns are not just challenges but open doors to intelligent investment strategies. Don't miss out. Subscribe now to stay tuned for upcoming informed analyses and join the conversation on the Warren Buffett investment strategy. Welcome to our channel and the journey to financial prosperity.
5. Warren Buffett views market fluctuations as opportunities to seize deals and build wealth, contrasting with Goldman Sachs' prediction of a possible 20% market decline. Renowned investor and business magnate Warren Buffett adopts a unique perspective in the face of financial market fluctuations. In his view, oscillations represent strategic opportunities for acquiring advantageous businesses and building long-term wealth. This approach stands out against more pessimistic projections, such as Goldman Sachs' anticipation of a potential 20% market decline. Furthermore, Michael Burr, known for his ability to anticipate financial crises, stands out by making a substantial $1.6 billion bet against the U.S. stock market. This action, marked by a pessimistic stance, sparks discussions about an imminent economic slowdown. The notable contrast between investment strategies, personified by Buffett and Burr, reflects the complexity of the current economic landscape and the diversity of interpretations among renowned investors.
4. Michael Burr, known for predicting the 2008 financial crisis, places a $1.6 billion bearish bet against the U.S. stock market, signaling a possible decline. Investor Michael Burr, notorious for accurately anticipating the 2008 financial crisis, stands out again by making a significant $1.6 billion bearish bet against the U.S. stock market. This notable financial move, characterized by a pessimistic stance, reverberates in financial circles, sparking debates about the implications of his actions. The scale of this bet, involving the acquisition of put options against $739 million in Invesco QQQ Trust ETF shares and $886 million in SPDR SANP ETF shares, paints a picture suggesting a potential decline in the stock markets. Burr's strategy, positioning himself bearishly, coincides with a moment of uncertainty in the market. His moves are interpreted as indicators of a cautious view regarding financial stability, contrasting with more optimistic expectations. This scenario, anchored in market decline projections, triggers reflections on the resilience of stock markets and the ability to anticipate possible economic turbulence. The potential impact of this significant bet resonates beyond the financial realm, reaching a broader sphere of investors, analysts, and market observers. The implications of this move, combined with the current environment of fluctuations and diverse predictions, contribute to the complexity of the investment landscape. Investors now face the challenge of interpreting these signals amid a constantly evolving global economic scenario, where Michael Burr's strategy serves as a significant point of discussion. However, it is crucial to emphasize that, although Burr's actions have garnered significant attention, the trajectory of markets is multifaceted and influenced by various factors. A thorough analysis of economic fundamentals, market trends, and long-term outlooks remains essential for investors seeking informed and balanced decision-making amid volatility.
3. The real estate market may experience regional variations in response to economic changes, providing opportunities for investors in specific areas. The real estate sector, highly sensitive to economic fluctuations, may witness significant regional variations in response to changes in the financial landscape. This dynamic presents a range of opportunities for discerning investors, especially in specific regions that reveal distinct patterns of behavior. A deeper analysis suggests that specific parts of the real estate market in the United States, such as areas in Florida, Arizona, Idaho, and Southern California, may experience notable declines of up to 30% compared to previous peaks. This regionalized landscape, permeated by geographical nuances, offers investors the perspective of differentiated strategies aligned with the particularities of each market. Identifying these opportunities not only requires a keen understanding of local economic trends but also demands a careful analysis of broader implications on global real estate markets. The ability to discern between more vulnerable and resilient areas amid a dynamic economic landscape becomes essential for investors seeking to capitalize on returns and minimize risks. Consequently, this period of real estate market fluctuations not only highlights regional divergences but also underscores the importance of a strategic and informed approach when considering investments in this sector. For real estate investors, the current economic instability should not be viewed solely as a challenge but as a strategic opportunity. The localized nature of property price fluctuations offers the prospect of carefully selecting markets that reflect potential appreciation, even amidst a broader landscape of economic uncertainties. Evaluating the variable impact of the economy on different regions allows investors to position themselves to take advantage of specific market conditions, adjusting their strategies as necessary. Ultimately, an understanding of economic cycles, coupled with insightful analysis of the regional real estate market, provides investors with the solid foundation necessary to make informed and strategically aligned decisions. The ability to discern not only momentary fluctuations but also long-term trends allows investors to capitalize not only on present volatilities but also on opportunities that will unfold over time.
2. The perception of cash has changed, with Citigroup suggesting it as a safe haven for wealth preservation during market declines, contradicting the previous view of cash is trash. The traditional perception of cash has been subject to reconsideration, notably driven by insights offered by Citigroup. Contrary to the previous notion that depreciated the value of money, the bank now suggests that cash can serve as a safe haven for wealth preservation during market declines. This perspective highlights a significant paradigm shift, wherein paper currency emerges as a defensive asset in adverse economic circumstances. The alteration in the narrative surrounding money reflects a more sophisticated understanding of its role during periods of financial instability. Previously labeled as cash is trash, this new perspective seeks to recognize the strategic importance of cash as a safeguard against market volatilities. Citigroup substantiates this view by arguing that, in recessive scenarios, money maintains its relative value, serving as a hedge against losses that may affect other assets during broader declines. The growing acceptance of cash as a wealth preservation asset, especially during market declines, is a notable turnaround in conventional perceptions. This understanding redefines the role of money, suggesting that instead of being dismissed as an inferior resource, it can be strategically employed to minimize the impact of adverse fluctuations on investors' portfolios. Ultimately, this shift in perspective underscores the importance of a balanced and adaptable approach in the face of the constantly evolving global economic landscape.
1. Economic downturns can offer advantages, including more accessible assets, reduced competition benefiting small businesses, and historical market cycle patterns supporting strategic moves for investors. Periods of economic decline, although often perceived as challenges, entail intrinsic complexity that can be interpreted as an arena of opportunities for insightful investors. One of the notable benefits during downturns is the accessibility of assets previously priced inaccessibly. The decline in prices of stocks, properties, and other investments provides investors with the possibility to acquire assets at more advantageous prices, promoting the strategic establishment or expansion of portfolios. The reduction in competition during unfavorable economic periods emerges as a peculiar but crucial consequence. Large corporations often adopt a conservative stance, reducing expenses and, in some cases, ceasing operations. Such a scenario provides an environment where small businesses, more agile and less impacted by expense cuts, can thrive. The decline in competition, therefore, not only creates an opportunity for smaller enterprises to consolidate their presence but also offers investors the chance to identify and support promising ventures. Historical analysis of market cycles adds a layer of strategic guidance during periods of economic decline. Recurring patterns of recessions and recoveries indicate that, although the market experiences temporary downturns, there is a tendency for subsequent recovery. For investors, this historical understanding suggests that strategic moves made during downturns can position favorably to capture gains as the market rebounds. Warren Buffett's strategy, celebrating market price declines as an opportunity, echoes this historical view that recognizes the cyclical and resilient nature of financial markets. Ultimately, investors' ability to capitalize on opportunities offered during periods of economic decline lies in the combination of discernment, adaptability, and a grounded understanding of the mechanisms governing financial markets. While economic turbulence may seem adverse at first glance, a deeper analysis reveals a fertile ground for strategic moves aimed at growth and capital preservation amid the vicissitudes of the global financial landscape.
Amid economic challenges, let's unravel together the strategies defining success in investments. From Warren Buffett to Michael Burr, we explore valuable insights that transcend market fluctuations. Now, I invite you to become an active part of this conversation. If you found value in this content, don't hesitate to like, share, and, most importantly, subscribe to not miss our upcoming analyses and developments in the financial universe. Your participation in the comments is crucial. We want to hear your perspectives and questions. Together, let's build an informed community ready to thrive financially. Until the next analysis, and remember, the key to success lies in the constant pursuit of knowledge. Invest in yourself, invest with us. Thank you for your attention and trust.